Good morning or afternoon, depending on where you're at. My name is Daniel Nelms, president of Final Frontiers Foundation, and we're doing another webinar today. And I'll go ahead and hand this over to everybody to introduce themselves. We got Michael here.
Hey, yep, I'm Michael Horn, and then we've got Scott next to me.
Well, as soon as we switched over, my speaker went off, and I'm trying to get it back on.
Okay, no worries.
If you want to nod your head, you can hear me. All right.
You certainly can.
I'll just have to fly blind as far as hearing myself. You don't need to hear me. It's the little wheels going around.
I can hear you.
I apologize. It was working 30 seconds ago. I tested all this to make sure. Anyhow, technology is great. Welcome to our webinar once again, and we have been, I think this is our fifth or sixth, and we are talking about missions, and specifically in regards to Final Frontiers Foundation, and how we can work harder or give more to God because He has given us so much and help get the gospel out. So if you've never been on here before, we are going to talk about the Bible. We're going to talk about the gospel. We're going to talk about missions. And just so you know, you're welcome to stay. But just so you know, today we're going to start talking about life insurance. And we're going to start out with term and what they call final expense. But this is going to be a rather protracted series. We're going to go in 3 or 4 parts, maybe even more. We're going to get into fairly simple concepts of term insurance and final expense. And then we're going to move all the way to premium financing and premium funding and how that works, and charitable funding using other types of life insurance. So, but today, let's just go ahead and get started. And Michael, if you want to pull up the slides. There we go. Okay. I often say every time that this young lady was created by God, and she's in the, I can never pronounce it correctly, Tuluban tribe down in the Honduras. And to my knowledge, she had never met anything or any people with cameras and stuff like that before, which is hard kind of to grasp in the Honduras there. But, and I could be wrong. But she definitely was not used to having a lot of people come in. But God knows her fears. And God knows what she's thinking in that picture. And God knows what she's thinking today. And I know that many Bibles have been given down there and people are receiving the Bible. And many of them are very hungry to hear the gospel. Many of them are very hungry to get a Bible. And many of them, when they get it, they treasure it. Our pastor just came back from the Honduras a few weeks ago, and he met an older lady that was in her home. And by our standards, it wasn't much, but she was very proud of it. And she was there reading her Bible that had been given to her. And so she is able to give the gospel to other people around where she lives. And that's what this is all about. It's not about, this tax gimmick or this investment gimmick. It's about finding better, more prudent and wise ways to give to the gospel and get the gospel out. But at the same time, being smart about it and using the tax advantages that may be there or may not be there. But so if you want to go to the next slide. Charitable planning and life insurance. Most people often think that they're two mutually exclusive things, but charitable planning can be very more powerful when we add life insurance to it. And often it is not as costly when we use life insurance, because life insurance can leverage the dollars that we're putting away and pennies on the dollar. For every 50 cents I put into life insurance, I can give $1 or $2 to a different cause. All right, next one. So like I said, we're going to start with term insurance. And it is just that, a term. And a term in this case means a specific period of time. The most basic would be what they call yearly renewable, or YRT, or ART, which is annually renewable. Very tricky nomenclature there, but just either annually or yearly. Those go up, the premium rates go up every year, and it's good for 1 year, and then it renews, but the rates go up. Those are usually only good for a temporary type situation where, like if you're a businessman and you take out a loan. I had an auto dealer that took out a loan several years ago, and the bank wanted him to have insurance. So we had to write up $1 million policy on him, but it was only for 3 years because he was going to pay off the loan in 3 years. So a 5-year term wouldn't have been of any use to him, and it saved a lot of costs for him. Then the next period would be 5 years, or a 10-year policy, or 15 or 20 years. There are carriers that are now offering a 25 and a 30-year term. 30-year is very appropriate to most mortgages, and there's a lot of products out there that are focused on mortgage protection that work towards your mortgage. They'll give you a benefit if you get sick. If you get a critical illness, they'll cover you and stuff like that. So it's very important to understand all the benefits in each policy. Some of these policies, 25 and 30 years, the last few years are not guaranteed. And by that, I mean, they may change the rates, or they may change some kind of benefit under it, or they may adjust something. That was in the beginning when they came out with 25 and 30 years. They're not so much that way anymore, but there are still some carriers out there that will cover you guaranteed up to 25 years, but the last 5 years, we'll take it a year at a time. So if you purchase a 30-year policy, be sure you understand what the provisions are. Does it carry you all the way to 30 years? Is it a mortgage-based product? Because you're gonna, with all those benefits added to it, it's gonna cost more. But if those benefits are a plus to you, then it might be worth it. Which leads to the next one, which is called return of premium term. That means you get all your money back. There is no interest earning on it though, and it costs more because they have to cover the cost of insurance. Well, if I never die, why is there a cost of insurance? All of our policies are put into a pool, and we are figured together as a class. I am 66 years old in the state of Indiana. So they figure my rate against all 66-year-olds in the state of Indiana. Then they charge me according to that. And 50-year-old or whatever the case is. One thing I want to point out at this point before we go any further is that every insurance carrier, be it State Farm, Allstate, Prudential, you name it, have to submit every single policy to every single state, the insurance commissioner, for approval in that state. So there are some states that don't approve certain policies. There are policies or products that will come out, and I look at them and go, that sounds pretty good. And I look down, oh, Indiana has not approved it yet. Now, sometimes Indiana will approve it later. So if somebody in Indiana comes to me and says, hey, I heard about this, and I said, well, it's not approved in Indiana yet. Well, can we go over to Illinois? Well, no, we can't do that. Now, if I'm licensed in Illinois and they actually live in Illinois, yes, I can do that. But for the most part, no, you can't hop across borders and do that kind of stuff. They kind of had that figured out a long time ago. But one thing is that over 90% of term policies are never paid out in a claim. So many, many people have paid that policy for 5, 10, 20 years and never needed it, but they did have that protection. So if we want to move to the next slide. So let's keep in mind that the only way term insurance can be of any benefit to any beneficiary is for you or me, the policyholder, to die. We have to pass away. Now, we can split that death benefit, the proceeds, among several beneficiaries. And another thing that you need to be aware of when you buy a life insurance policy is, do you want your beneficiaries to be on a per capita basis or per stirpe basis? What does that mean? It's Latin. Per capita means per head, which sounds kind of has a kind of a bad ring to it. But what that means is that many of you may know we lost a daughter when she was 16 years old. I have life insurance. She's a beneficiary. If I made it per capita, then her portion would have been split up between all the other children. But per stirpes, had she had children, her stirpes would make it go to her children next. So when you buy a life insurance policy, make sure you understand that and have your agent, do it the way you want it to do. If you want it to be split between just your kids, it sounds awful, but there are situations where they don't want it to go beyond that for whatever reason. And also when we talk about the next point is also by issue. That's another term they use, or even blood issue. What that means is your natural children. There are cases of divorce where there is family turmoil and the policyholder does not want anything to go to the stepchildren. It is not for me to agree or disagree. It is for me to represent the policyholder and what they want. And if that's the case, then we would designate it only for natural issue or blood issue children. So those are some things to remember. And then if I want to designate, well, I guess we'll go to the next slide. Can I make a charity the beneficiary or a beneficiary? Yes, in both cases. But as I mentioned before, it is advisable to have all parties affected involved in the planning. And in most cases, this is going to be your family, your wife, and your children. And there can be other people involved. And we have extended families and we have different situations now. But however you set it up, make sure that everybody involved understands what you're trying to accomplish. Sit down with your kids and say, my heart is with missions, and mine is. And my beneficiary, part of it is going to go to missions. And I've only been working with Final Frontiers less than a year. I can change the beneficiary and make Final Frontiers a partial beneficiary. And I believe in Final Frontiers. I love what they're doing. And yes, I am making a plug because I believe in them. A shameless plug, by the way. Many times there can be long-term hurt in a family because there were expectations that there would be more funds coming to them. And some of the beneficiaries, either be it children or loved ones or a spouse or whatever the case is, they can be offended that their money went to a charity. Their money went to missions, and their heart's not really in missions. And they were banking on that. But if we sit down with them ahead of time and we go over that and said, this is my plan, this is what I want to do. It is your money. You can dictate. The other thing about that, designating someone or an organization a beneficiary avoids probate. So it can't be challenged. Once you've set it up as a beneficiary, you can't challenge it. There have been attempts, and to my knowledge, there has been no successful challenges. Now, you may be able to pull one out somewhere, but that very rarely happens. And usually what has to happen there is they have to prove incompetency. But if you change the beneficiary, if you set up a beneficiary, 20 years ago when you were competent, that won't survive. But if you change the beneficiary, 6 months before you died, that could be challenged, especially if you can prove that you weren't mentally and that you weren't mentally competent at the time. There are cases where care workers have tricked people they're taking care of into designating them as a beneficiary, but it was found out and reversed and taken care of. So, like I said, very, very few cases where it's been successful. There was one case over in Illinois where a lady was taking care of a lady in her 80s and got her to sign off on transferring all these funds and accounts over to her. But they found out. She spent a lot of it, but they found out about it and they were able to recover some of it. So, but life insurance, that wasn't successful. But like her bank account, her 401k, those kind of accounts, she was able to get into that. And then make sure you know who you're dealing with. Check them out. All right, on to the next one. What about taxes? Well, the death benefit, taxes are on everybody's mind all the time, right? The death benefit itself passes to all beneficiaries tax-free if you take it as a lump sum. So let's say I have a $100,000 policy and God calls me home. My wife would get $100,000 tax-free. All life insurance carriers will offer an option where you can get it as a payment, an annual payment, a monthly payment. If you do that, they are going to put it into an account and you're going to earn interest. And it basically becomes an annuity payment. And you'll earn, 3, 4, 5% interest. You will pay taxes on that. You won't pay taxes on the basis, but you will pay taxes on that income that you got over and above what was put in there, your earnings, be it 5% or whatever the case is. The premiums themselves are generally not tax deductible. So I take out a policy and I want to make Final Frontiers the beneficiary, and that's a charity. Can I make my premiums tax deductible? Generally speaking, no, you cannot. Now, there's going to be somebody that says, yes, you can. Yes, you can, but no, you can't. There are ways to make them deductible, but in most cases, it's not really worth the effort and the cost because it usually will cost you something to do that. And if we're paying $50 a month for a term policy, it's generally not worth it. So, but there are cases where we can, but we'll talk about that in our next webinar. So, all right, next slide, please. So, term insurance is pretty cut and dried, kind of basic. There are variations on it within that, but for the most part, term insurance is pretty basic. And it only goes for a certain amount of time. And when it's done, it's over. You get no refund unless you buy return of premium, then there's no earnings. Final expense is also referred to as a burial policy. Typical death benefits range from $5,000 to $40,000. Again, you'll find exceptions. There's one carrier that will go up to $150,000, but it's going to be pretty expensive. There are carriers that will go as low as $1,000, but that's like, why? What $1,000 is not going to be of any benefit, really. I remember when I first started in the business, I don't know if I can tell the carrier or not, but we, as an agent, we have to be careful about what we say about different companies and about securities. So for licensing reasons, I have to be careful. So my first carrier I worked for, they gave me what they called orphans, which means customers that had no agent. The agent had moved on or whatever the case is. And so I would go visit some of them. And then they sent me endowment policies. An endowment policy is when you have paid enough premiums in that the earnings and everything equal the death benefit. And they sent me to deliver some endowment checks to some people that, had $1,000 policies. And they bought it back in 1956 or something like that. And I went to them and I gave them a check. And they would say, I bought this back in 1956 and I thought 1,000 would be plenty. But now it's not even I don't even think it will pay to open up the gravesite. 5,000 is your average price of cremation. And more people are opting for that simply because of the cost. Some people are not comfortable even talking about cremation, but that is the way a lot of the industry is moving. And when cremation first came out, it was in many cases less than 1,000, less than 2,000, but now it's around 5,000. And in some cases, even a little more. The average funeral is anywhere from $10,000 to $15,000, depending, what kind of things, what kind of coffin you have and so on and so forth, and where you're located. And then most people get a little more to leave to their children or whoever they have behind. So most policies are around $20,000. These are permanent policies. They're based on whole life. 90% of them are whole life policies. So they will build up a cash value and they will endow at some point. If you live, most of them are around 120 years of age where they will endow. If I have a $20,000 policy, when I reach 120 years old, whoa, that's a long way off. When I reach 120 years old, they'll send me a check for $20,000. In the meantime, it will build up a cash value. And if I want to, I can access that for a loan. Let's say I have a final expense policy and I want to send $1,000, $2,000 to Final Frontiers, and I have, $5,000 in my cash value. I can call them up and say, I want a loan for $2,000. They'll send you a check for $2,000. Now, whether or not you pay that off is up to you. There may be interest payments, but it's my money. Well, actually, no, it's not. Your money stays in the policy. Your money is the collateral for the loan. So there is interest. The other side of that is that because there's interest, there are no taxes. But if you took out that money and withdrew it, you would have taxes on anything above your cost basis of how much you've paid into that. So let's say at that point you've paid in $3,000. I'm just throwing out numbers. I know the accountants out there are going crazy, but let's say you put in $3,000 and your cash value was $5,000 and you took out a $3,000 loan. Well, now you're above your cost basis. So you would pay a little bit of taxes. Anyhow, it's almost always whole life. There are a few carriers that use what they call index universal life because that's based on an index like the S&P 500. We're going to get into index universal at a future date because it's a little more complicated. But the main thing about that is that people like the possibility of higher performance, so higher earnings within the account. And in some cases, it's less expensive because of that higher performance. I have one carrier, I quoted a lady who just turned 60 years old, and $20,000 policy. Yeah, $20,000 policy was $60 a month. Same carrier, but this carrier has universal life, index universal life. That was $44 a month. But there are things you need to be aware of with that, and it's beyond the scope of what we're talking about that. So if you call your agent and say, I want to talk about this index universal life, be sure you understand completely how it works. Final expense uses what they call simplified underwriting, simplified issue underwriting. There are 3 tiers of underwriting. There's fully underwritten, which what is what most policies are. So you sit down and you fill out an application, and sometimes they will send a nurse or paramedic to come out and take your blood pressure and check your heartbeat and then plug you into an EKG. It depends on how much you're getting and how old you are and where you live and all that kind of stuff. That's a fully underwritten policy. Then they'll decide what class you are. Are you super preferred? Are you preferred? Are you standard? Are you table rated? And then it goes beyond that. There's many, many different classes on a fully underwritten. That allows the insurer to target the cost as efficiently as possible per each policyholder. Why pay more if your health is good than what you need? Try to get yourself the best rate. The lower the rate, the more challenging it is, but it's definitely worth it. And there can be a huge difference in the rates, which is going to impact how well the policy will grow. Simplified underwriting kind of spreads all across the spectrum. They have just several questions, and if you can answer all those questions successfully, then you'll get the policy. Your rates are going to be a little higher because, like I said, there's not as many questions, so it's not as targeted. So they have to make up the difference in their rates. There's also what they call guaranteed issue. And usually that's 3 or 4 questions. And one question, no, will knock you out. But it's pretty expensive. And you will be surprised at how much you pay and how little you get. And if there's any way to avoid that, I would avoid it. But if you're in a situation where you must have something and you do not want your family to have to take care of the expenses, guaranteed issue may be a help for you. All right. That was a whole lot to go into. That's probably a whole nother webinar in itself, but let's go into the next slide. So life insurance can be a very powerful tool. You can leverage your dollars to provide security for your family, and you can help a charitable cause like missions and Final Frontiers as well. You could some people buy a separate policy. You know, let's like I mentioned, a term policy for a 30-year-old. I have a 33-year-old lady I'm writing a policy on out in California, and her base policy, it's the $150,000, but the base policy is less than $100 a month, and that's a whole life policy. If that was a term policy, it would be less than $50 a month. So it can be very affordable, and some people buy a policy and they designate the entire amount to a charity. Again, like Final Frontiers. It can be a powerful tool, and with proper structure in planning, life insurance can provide certain tax benefits as well. Like I said, we can pull out that cash value tax-free, and a lot of people use that for retirement planning, and we're going to get into that down the road. It's unbelievably powerful for a lot of people. We are seeing people write $50 million policies using it for retirement planning. And these are not non-smart people. They know they got where they're going. They've gotten where they are by being smart about a lot of things and taking advantage of the tax benefits and the power of it. There is no more powerful tool than a properly utilized life insurance policy. The main thing is that you sit down with somebody that you can trust and that's competent and knows what they're doing, and they design it for what you want. Not trying to tell you what they want you to do and say, oh, you need this. You need somebody who's going to say, what do you want to accomplish? Well, I want to take care of my family, but I'd also like to help missions. All right, let's find a way to make that happen for you. And let's say you have some kind of health condition. It can be done. There's ways to do it. And so you sit down with somebody who knows what they're doing, you can find ways to accomplish things. All right. Next slide, please. So I want to thank you for taking the time to be here with us today. I know in some ways this was kind of a lot of ground to cover and we kind of zipped through it. But again, you want to sit down with somebody face to face or a Zoom call where they can answer your questions and set it up according to what you want. And this is what we're doing here is all about missions and getting the gospel out to the world. You know, I think of what is going on over in the Middle East, in Iran and Pakistan and Iraq, and how God is using people over there to get the gospel out. Some amazing, incredible stories. In India, amazing, incredible stories. In the Honduras, people are hearing the gospel and they're coming to the knowledge of Christ and their lives are being changed. And we can all be a part of that. And God gave us so much. He gave his only begotten Son, that whosoever believeth in him, whosoever believeth in him. And we can help make that possible. So I want to thank you for your time today, and we'll see you next time. Thank you.
Good talk. Well, it was exciting to learn more about insurance. I've got a couple of policies stuff, and I didn't really understand them, to be honest.
Yeah, but it looks like Brother Scott can't hear us. So if you have any questions, feel free to email us. You can use support@finalfrontiers.world. Shoot in any questions and we can forward those on to Scott if you have anything specific you're not sure about. We plan on coming back for part 2 later next month, so be on the lookout for any posts and emails so you can get registered for that. Thank you for joining us, and we'll see you all soon.
Bye.